All right, let's go. Let's have a very short discussion of the different cost functions that we usually face in economics. On top, you see a table. In the left column, you see the different types of costs you usually have to deal with. In the middle, you see the general formula how to compute them. And in the right column, you see an example with a specific cost function. And below that, you see a little diagram where we actually have illustrated the most important cost functions, and you will also see how they are connected. In the first line in the table, you see the total costs, and the rule just tells you if you want to produce X units of the output, right? You plug it in there, and it tells you how expensive it is to produce in total your output. In the second column, you have the fixed costs. These are the costs that you have even if you want to produce 0 units of output. Even if you don't produce anything at all, you still have to pay the fixed costs. So in our example, you plug in X equals 0, right? You don't produce anything and you still have to pay these costs of 15. Third line, that's the variable cost. And variable costs are exactly the opposite of the fixed costs. So you compute them by taking your total costs, right, the first column, and ignore the fixed costs, that's the 15. So what's left is the variable costs, so x to the power 3 minus 5x squared plus 10x. The next line, and that's actually the most important one, I would say, that's the marginal costs. And if you look at the formula, you already see the marginal costs are the first derivative of the total costs. And that already gives you a hint how to interpret them, because the marginal costs tell you how expensive it is to produce one additional unit. And you're computing them by taking the first derivatives of the total cost function. So if you take the first derivative of the cost function, you start with x to the power 3. First derivative is 3x to the power 2 minus 5x squared. First derivative is minus 10x. And first derivative of 10x is just plus 10. And that's the first function that we also drew in our diagram. And you see that the marginal costs are first decreasing and then increasing. And that's basically a standard feature, because the idea is that at the beginning, if you're producing very few units and you're starting to hire more workers and using more machines, then it gets cheaper and cheaper and cheaper to further increase your production, right? Remember, marginal costs tell you how expensive it is to produce another unit. So at the beginning, it's getting cheaper to produce the next one. And the next one is even cheaper, and so on. But at some point, you reach a lowest point of the marginal cost, and then the marginal costs start to increase. And that's basically where you reach a point where it's getting more expensive again to increase your production. For example, because your workers are already very exhausted, right? And you use your machines already at capacity, basically. So at this point, increasing your output further and further and further increases the costs of each additional unit that you are producing. The next one are the average total costs, which, well, the name already tells you, right? You take your total costs of production and divide it by the amount of units that you produce. So that's C over X. So you take here the first line, right? And just divide it by X, and you have the average total costs. That's the blue line that we drew here. The average fixed costs, well, that's not a big surprise. You take the fixed costs and divide them by the output that you're producing. And the point is, well, you just take the 15, right, and divide it by X. And that's why, obviously, the average fixed costs are decreasing with the output that you're producing, right? Some people call this fixed cost regression. Well, you just divide the fixed costs by more and more units of the output. And finally, you have the average variable costs. For the average variable costs, you, surprise, divide the variable costs by the output X, and you obtain the green curve. Right, it's this one here. So we are basically done, but for our exam, we have to remember one very important property. And this property basically connects the marginal costs, how expensive is it to produce another unit, and the two types of variable costs. Because if we look closely, then you see that the marginal costs here intersect the average variable costs and the average total costs in their minimum. And that's not a coincidence, but that's a standard property that's asked in more or less every exam. And the intuition behind that is as follows. Let's explain it for the average total cost, but it also works for the other one. So the idea is the marginal costs once again tell you how expensive it is to produce another unit. So here in this area, where the marginal costs are below the average total costs, that tells you the next unit that you're producing. So here in this area, let's say you're already producing 2 units. Then the marginal cost of the next units are something like 2. So the next unit that you produce is costing you 2. But the average cost of all units that you already have produced before is like 12. So far your average costs are 12, but the next unit only costs you 2. So that means your average cost, if you continue producing more, will decline because the next units cost you less than so far the average cost of your production was. So that means as long as the marginal costs are below the average total costs, your average total costs will decline. And on the other side, as soon as the marginal costs basically intersect the average total costs, it's exactly the opposite, right? As soon as the marginal costs are above the average total costs, the next unit costs you more than the average unit has cost you before, and therefore your average costs will increase again. And you can make the same argument with the average variable costs. It's exactly the same idea. So that's very important because that's asked very often in exams. And finally, also keep the following in mind. That's also related to the lowest points of the two average cost functions. Because the lowest point, the minimum of the average total costs here, also shows you the lowest price. So here is something like 9. Shows you the lowest price for which the firm is willing to stay in the market in the long run. So in our case, if the market price in the long run is below $9 or euros or whatever, right? There's no way the firm can cover its costs, right? Because the lowest average cost per output unit is like 9 here, the minimum of the average total cost. So if the price is lower, there's no way the firm can avoid losses in the long run. And the minimum of the average variable costs, well, it's the same thing, but we are just ignoring fixed costs. That's the whole point of the variable costs, we are ignoring fixed costs. So that's the lowest price the firm is willing to stay in the market in the short run. Why? Because in the short run, that's usually the assumption, the fixed costs cannot be avoided. So basically they are sunk costs, right? We are just ignoring them when we make a decision because we have to pay them anyway, right? So the only relevant costs that we could avoid in the short run are the variable costs. But if the price in the market is even below the minimum of the average variable costs, well, then even in the short run, when we don't consider the fixed costs, still for us it's optimal to leave the market. So long story short, the minimum of the average variable costs, here are about 4, is the minimum price that we need to stay in the market in the short run. And the minimum of the average total cost is the minimum price for which we are willing to stay in the market in the long run. And again, you find both minimums by looking at the point where the marginal costs just cross them. Okay, that's it. Good luck. Subscribe, like, and send me money.